Okay, good morning, everybody. Welcome back. Today is Monday. Today we're going to be getting into chapter 4. Before I get started on that, I just kind of want to do just a little quick review on what we've covered so far in the course. We've covered the first 3 chapters. We're covering 12 chapters this course. The book actually has 14. We're only doing the first 12, so we're about a fourth of the way through the content so far. Is everyone feeling pretty comfortable with it so far? Chapter 1, I think it just pretty much was just an introduction to governmental not-for-profit accounting. We got into the differences between, some things we could expect to see between a for-profit business accounting for it and that of a not-for-profit one or for a governmental body. We know that the governments, obviously, they are more prone to having to be accountable for the money they bring in from the taxpayers. So we know that's a little bit of a difference between the two. The accountability, they have to be a lot more accountable with dealing with other people's money when it's the involuntary non-exchange transactions like taxes and stuff of that sort. So they have a right to know where the money's being spent. So that's a little difference there. We know the comprehensive annual financial report is the government's report that they have at the end of the year that's showing everything they need to the readers. We know those reports are a little more in-depth detail than the for business financial statements. We have 11 funds. We know governmental accounting and not-for-profit uses fund accounting. We have 3 different types of funds. We have the 5 governmental type funds. We have 2 fiduciary funds, and then the 4 fiduciary type funds. We know that these funds operate on different bases of accounting. The 5 governmental funds operate on the modified accrual, the current financial resource measurement focus, and then the 2 proprietaries and the 4 fiduciaries operate on the full-blown accrual. We also know that we have the fund level financial statements and the government-wide statements. The government-wide statements are also on the actual accrual basis, so the economic resource measurement focus. The statements for the government-wide are the government-wide statement of net position and the government-wide statement of activities. If we recall, there's only 2. For each of the governmental funds, we know we have different financial statements as well. Let's first talk on what those governmental funds are. Remember, there's 5. We have the permanent fund, the debt service fund, capital projects, special revenue, and the general fund. We know these are all on the modified accrual basis. The financial statements for them is going to be the balance sheet, statement of revenues, expenditures, remember not expenses, expenditures, and the changes in fund balances. And then also we're going to have the reconciliation because we know we have a different basis of accounting, right? So we're going to have to reconcile to the government-wides. The 2 proprietary type funds are internal service funds and the enterprise funds. If we recall, remember, we have to determine whether there's governmental activities or business-like activities. Remember, the internal service fund, its main purpose is to provide services to the internal government, so that's going to be considered a governmental type activity when preparing government-wide statements. Enterprise fund primarily services the outside customers, right? So that's going to be a business type activity. The financial statements that we're concerned with the proprietary funds was the statement of net position, the statement of revenues and expenses and changes in fund net position, and then the statement of cash flows as well. If you recall, the statement of cash flows is only relative or only applies to proprietary funds. That's the only area we're going to see the statement of cash flows. And then the fiduciary funds, we have the 4. We have the private purpose trust fund, the investment trust fund, the pension trust fund, and the custodial funds. And we all know that we're holding this in a fiduciary capacity, so as a third-party trustee, so it's not really our money. We know that the fiduciary funds are not included in government-wide statements when we create those funds or when we build those statements because it's not our resources. We're just merely holding them as a trustee for another party. The financial statements we're concerned with there, statement of fiduciary net position and statement of changes in fiduciary net position. So pretty straightforward there. So that's pretty much chapters 1 and 2. Just a little, pretty much a helicopter view over them. Chapter 3, we got into dealing with budgetary accounts and activity accounts, stuff that we actually that we have to close, and stuff the accounts that stay open. If you recall, the budgetary accounts deals with encumbrances. When you encumber funds, we have the encumbrances and the reserve for encumbrances, the budgetary fund balance. And we also have, when we set the budgetary accounts, we have expected revenues, expected other sources. Then we have the appropriations and expected other uses, and then we plug with the fund balance, if we recall that. So that's pretty much getting into in what chapter 3 was. Before we move on to chapter 4, I want to just show a couple more things and more of an in-depth entry when setting a budget or when dealing with just transactions of counting revenues of that sort. So if you recall, when we set the budget, if you recall, remember, it's a debit to estimated revenues, a debit to estimated other financing sources, a credit to appropriations, and a credit to estimated other financing uses, and then the budgetary fund balance was a plug, right, depending on which was greater debits or credits. So we just had the whole control account of the budgetary accounts that we were looking at. So it was just one debit, or a debit to each relative thing, a debit for the estimated revenues and a debit for the estimated other financing sources. Well, we know, obviously, say for estimated revenues, there's going to be different revenues coming in from taxes, different sources, because if you recall, revenues are accounted for by source, where the money's coming from. So just a quick example here. And this is on the appendix, out of the appendix of chapter 3, but I just wanted to just go over it really fast here before we jump into chapter 4. So if you can see at the top here, it says estimated revenues control of 1.35 million. Then we have the estimated other financing source control. So that's telling us it's not going to be anywhere not expecting anything else. And then we just have the budgetary fund balance of 1.35. So if you notice, this is just half of setting the budget, right? This is just a 2 debit side of it. So that's the general ledger, what we'd see, and that'd be the overall entry, right? Those are the control accounts right there with the general ledger. Then if you can see to the right, we have a subsidiary ledger. Now this is going to be actually the makeup or the itemized detail of that estimated revenues control. So we know that's a debit, right? But the actual makeup of that 1.35, as we can see, the estimated revenues ledger, we know 882,500 of that is coming from taxes. Licenses and permits is 125,500. Intergovernmental revenues, 200,000, and so on and so forth, right? So we can see that's where the 1.35 came from, right? So that's why I really want to show this. So a lot of times, like if, say for example, on a test, I could have you set a budget, and I could have within a problem then say, well, taxes was X amount of money, give you some pertinent data here, right? And it's important to know what's going to be considered as revenues or what's going to be considered as other estimated other financing source control, right? And see, that's why it's important to know how we talk estimated other financing sources. Estimated other financing sources is what 2 items appear in that?
It's transfers,
right,
and loans.
Right. So if we're gonna incur debt, right? So that's our sources. So we know that those are items to look out for at estimated other financing sources. We know estimated revenues to look out stuff for taxes, license and permits. Remember, because it's stuff for the estimated revenues. It's going to be more so that stuff like taxes and stuff of that nature. So just this is just to give you an idea of what some more advanced situations could look like. That's going to be itemized. So to know what to consider as estimated revenues, know what to consider as estimated other financing sources. So that's just a little detail. That's the estimated what we're bringing in, the debit side of the setting the budget. Does that make sense? Same thing here. Let's just take a little glance here at the appropriation side of it. So once again here, we got budgetary fund balance of 1.3 million. We know this is a plug number, right? And then we have a credit to appropriations control. We can see the amount there. And estimated other financing uses control. We can see the 74,500 there. So same thing here as we just looked at. We're just itemizing it, right? So that's the control, the general ledger, the control account there. And then here we got the makeup of it, or the itemized detail in the subsidiary ledger. So pretty much this is the breakdown of the appropriations, right? So there we see the 1.225, 500,000. That makes it up. Same thing, estimated other financing uses. Remember, it's only one thing there. One thing we're concerned, transfers out. That's the only item we have to look at. And that's 74,500 to make up the estimated other financing uses. So does that make sense? So when we're setting this budget to try to give you an idea of what items to expect to see within each of those categories? To just know, I mean, it could be a simple problem. I could just give you a number for estimated revenues, a number for estimated other financing sources, a number for appropriations. You follow me? Or I could give you itemized details or itemized items that actually relate to each one of those categories. And then you would have to obviously group them together to be able to make that debit entry of estimated revenues or estimated other financing sources, uses, whatever it might be, to be able to find out whatever that actual budget is. So does that make sense how I could actually go about asking questions about that? So that makes sense why we have to know revenues, the sources of revenues, and by function. Remember, appropriations by function: general government, public safety, highways and streets. So if you really think about it, it's not too difficult. It's just there's a lot of information going on, right? So does that make more sense on how to itemize the budget, like the different itemized parts of what is appropriation, what is estimated revenues, actually seeing it with, so just showing you the subsidiary ledger. That's the only thing we're adding right here is just the subsidiary ledger, just to show you the different items that could be included. Same thing here. So that's when setting the budget, right? This right here, dealing with revenues. So obviously we can see here we have a debit of cash. So we know that assets are original debits when we make the double entry of it for accounting, right? So obviously if we're getting cash, then we're going to debit it because that asset's increasing, right? So we debit cash, credit revenues control, because we know revenues is an original credit, right? So right here, we're not concerned with itemizing the cash because cash is cash, right? So revenues ledger, however, we are concerned with where that money is coming from, where that source of the revenue is. So when we make that credit of the 1.314, we can see here, same thing, the subsidiary ledger is just giving us an itemized detail of where the source of that revenue actually came from. So it's just showing the actual credits that, so when we're building the statements, obviously, you know, we're building it, itemizing it line by line, right? So it's just pretty much just showing you what that revenue, what the sources of revenue was. Make sense? See the pattern there? It's the same thing, just itemizing it down. And this is something you're probably familiar with this in your other parts of accounting. You know, you could have your control account and different things, different subsidiary ledger entries that make up that control account. So same thing here, nothing different. I just want to point out that it's not always going to be as easy as debiting estimated revenues. It could be debit, you know, you have to itemize what those different sources are sometimes. Same thing here. So encumbrances. So we know when we encumber funds, it's because we've placed an order for something, right? There's no liability incurred at that point, but we have to keep up with our budget, right? So if we place an order, we have to know that that order's out there, and that eventually we are going to incur a liability because of placing that order. So we encumber the funds to keep us from overspending. So we can see here, we're used to seeing this entry. So obviously the government or the city has ordered a little over $500,000 worth of supplies, right? Or something over that amount of money. So they encumbered the funds with the debit to encumbrance control, and then the credit to budgetary fund balance reserved for encumbrances, because we know that's the entry we make when we encumber funds. But here, once again, we're just showing the subsidiary ledger, the itemized breakdown of where these encumbrances actually, why we're encumbering the funds. So we obviously are encumbering $73,200 for general government, $115,100 for public safety, and so on and so forth. Highway, streets, 34.6. So we get it, right? So that's what we encumbered it for. Here, we've obviously received. This is just a continuation with the stuff we've encumbered. So now we've actually received some of the stuff we've actually ordered or whatever it is, but it's a little different. So now we reverse the encumbrance, right? So we debit the budgetary fund balance reserved for encumbrances, credit encumbrance control. So that now there's nothing encumbered, right? We've unencumbered them. So now we've actually got the liability. But for unencumbering them, so if they're reversing the encumbrances, obviously we have to reverse the ones that we originally encumbered. They could be a little different because remember, sometimes when we receive something, we might not receive all of it at once. So we just unencumber what we actually receive, right? So there could be some stuff still encumbered. But anyways, this is just showing you what we would credit, which is the same thing that we encumbered on the last slide, but just some of them have different amounts, obviously. Obviously, at that point, if we've received the goods, we've unencumbered the goods or the money that we had encumbered. The next step is to set up the liability, right, or make payment to the vendor. In this case, we've set up the liability because now we've debited expenditures control, right? Now this is the actually entry that is going to be in the general ledger for the financial statements, right? The other are just budgetary entries. So now we debit expenditures control and credit accounts payable. Right here, we're just mainly same thing, breaking down the different itemized details of what those expenditures are. So we know we've spent $69,100 of expenditures on general government, public safety 115,100, and so on and so forth. So you get the gist of it. So that's pretty much that's it for the review on how to go about unencumbering stuff, encumbering it, setting the budget, and dealing with revenues. Just my main point here is to show you that there's two ledgers here. You're going to have the main control ledger, your general ledger, with just the main number here, and then you also have to have your subsidiary ledger to keep up with the itemized transactions, knowing revenues by source, expenditures by function, and stuff of that sort. So it's just keeping it up, which obviously that's the only way to get your line items within your financials is to know where they go, or to plug them in on the entries, right? So that makes sense why we have to do this. Does that make sense? So if I would, like I said before, if I would say, if for example, on a test, if I have a problem saying, okay, this city of Louisville expects this property taxes and this much, fines and forfeitures, we know those two items would go into estimated revenues. They've incurred long-term debt for this, and they're expecting the transfer of that. That's estimated other financing uses, right? Or sources, I'm sorry. So we get the gist of what I'm going with right there. So that's it for chapter 3 now. Everyone should be good on it. Remember, chapter 3's homework with the Connect stuff will be due this Sunday. Chapter 2 was due, was it chapter 3 was due this past week, I want to say, maybe? Or let me look here. I actually.
It was chapter 2 that was just due.
Chapter 2 was, I believe you're right. I get my courses mixed up sometimes. So chapter 2 was due on the 2nd, right. So chapter 3 will be due on the 9th. So that'll be due this week. And just as a reminder, chapter 3's Connect assignments, don't forget they're due this Sunday by 11:59. So we've covered chapters 1 through 3 now. Everyone's pretty good on it. Understands, gets the gist of it. Doing pretty good. Okay, let's see here. So where are we at here in Moodle? So we're in this week here. We've finished chapter 3 now. Now we're going to get into chapter 4. All right. So chapter 4 is accounting for the general and special revenue funds. So our learning objectives for this chapter, we want to apply the modified accrual basis of accounting in the recording of a typical transaction of a general or special revenue fund. So we're going to get into how we actually make these journal entries. It's going to be some, like we said, so some typical transactions that we're going to see here that we would expect a government or a different municipality to actually make into these type of funds. We want to prepare closing entries and classify fund balances. So we know the closing entries, we seen in last chapter what entries have to be closed and which ones stay open. So the closing entries are relative to budgetary accounts and your operational accounts, right? And encumbrances. So those are going to be the 3 closings. And we'll get more into it, more detail into this chapter. But just recall, for the closing process, your operational ones, which is going to be your revenues, expenditures, and stuff of that sort. Your encumbrance accounts needs to be closed, and also your budgetary accounts. So that's the closing entries that Those are the accounts that will be affected by the closing entries. Classifying fund balances, obviously we got into pretty good detail on Chapter 3. I forgot to do that on the review, but we know that the fund balance is either spendable or non-spendable. If it's non-spendable, obviously you can't spend it. It's been, the restrictions placed by outside donors or debt covenants, stuff of that sort. And if it is spendable, there's 4 categories. You have your restricted, committed, assigned, and unassigned. So we have the different categories there. So we know the classification of fund balances and what constitutes it being in each one of those fund balances. Just as a review, if funds are encumbered at the year end, which fund is it going to be accounted for in, and what classification of fund balances will it be if there's encumbered funds at the end of the accounting period?
Encumbered funds are in the general fund and they're assigned.
Right, absolutely. Good job. And lastly, we're going to prepare the fund basis financial statements for a general or special revenue fund. So those are going to be our learning objectives. So a little review here on fund accounting. The purpose of fund accounting is to segregate those financial resources that have constraints or limitations on their use so that the government may demonstrate compliance with those limitations. Obviously, the general fund reports those resources not subject to such restrictions. So as we recall, the general fund we know is for its main operational fund, right? The general fund is also the only fund that can have a positive unassigned fund balance, right? All of the other funds, the other 4 governmental funds, have to at least be assigned, because if not, then the money has to go back to the general fund. So obviously, if the general fund is just for general operational purposes, then obviously those resources are not going to be as specifically tailored or earmarked towards specific purposes if they're within the general fund, unless obviously they're assigned or committed or whatever that might be. So obviously, the purpose of fund accounting, once again, is to segregate those resources, right? We want to make sure if it's earmarked for capital projects, we want it in that capital projects fund. If it's for debt, paying off debt, for outstanding interest and principal, we want it in the debt service fund, right? So that's the whole purpose of fund accounting: segregate resources. Okay. So fund definitions. So the general fund, once again, the general fund is used to account for and report all financial resources that are not accounted for or reported in another fund. So we know that if it's not in one of the other funds, then it's going to the general fund, because that is obviously, as the name says, general purpose fund. Excuse me. So what is the purpose of the general fund? Many resources have no limitations on their use and do not require segregation. The general fund accounts for any resources not reported in one of the other funds, which is the limited use fund, obviously, because we know capital projects is limited only for that of capital projects, right? So obviously that's the general fund's purpose. So every general purpose government will have one and only one general fund. Remember that rule. They must have a general fund, and they cannot have duplicate general funds. Only one general fund. They have to have a general fund. So general fund, like we said, general purpose spending of the government, right? Okay, now special revenue funds. Obviously, these account for and report the proceeds of specific revenue sources that are either restricted or committed. So really pay attention there. These are restricted or committed. It does not include assigned. So to expenditure for specified purpose other than debt service or capital projects, right? So special revenue funds is for something other than debt service or capital projects, right? So if we just have someone wants like a special revenue to maybe work on, I don't know, whatever a special purpose can be. I can't think of something off the top of my head, but anything other than for capital projects or debt service, if it by default it's going to fall into special revenue. But we want to make sure, because GASB does give it special attention, that that the resources have to be derived from either restricted or committed sources. If it's assigned, if it's merely just assigned, then it needs to just be shut down. The special revenue fund needs to be just closed, and the money needs to be moved back to the general fund. So it has to be either restricted or committed. The purpose of the special revenue funds, obviously, it's an example of a fund established because of constraints placed on the use of government resources. It says here, Note, however, that special revenue funds are not used if the resources are required to be used to acquire capital assets. In that case, obviously a capital projects fund would be used, right? Or if the payment of interest or principal on long-term debt, we're not going to use a special revenue fund. We're going to use a debt service fund, right? So it's important, just special revenue funds. It has to be restricted or committed, right? It can't be merely assigned because then we need to close that fund and put it back to the general fund, right? Can't be for capital projects or for debt outlay because that's going to be the debt service fund or capital projects fund, right? So that's pretty much the purpose of the special revenue fund and the constraints that come along with it. Once again, GASB gave particular guidance for the use of special revenue funds. So although other resources may supplement a special revenue fund, assignment of resources is not sufficient for the establishment of a special revenue fund. So once again, assignment of resources not being sufficient means they can't be assigned, right? They have to be restricted or committed. Further, if the government expects that a substantial portion of the resources supporting a special revenue fund's activities are going to no longer be derived from restricted or committed revenue sources, then the government should discontinue the use of the special revenue fund and report the fund's remaining resources in the general fund. So we know that. It has to be either restricted or committed. Assignment of funds does not account. So once again, if you recall, we have two different bases of accounting, right? We have the modified accrual, which is applied to what type of funds?
The general.
That's one of them.
Oh,
The general fund is what type
all
of
the
fund?
governmental.
All governmental. So they operate on modified accrual, right? Which is the current financial resource measurement focus. Meaning there's going to be no long-term debt or long-term liabilities or long-term assets like capital assets and included within those because we're not accounting for any of those. Only current financial resource measurement, right? So modified accrual is for governmental funds, right? There's 5 of them. They all use modified. The 2 proprietary and the 4 fiduciary use what?
The
Accrual basis, right. Government-wide statements use what?
The
Accrual, right. Modified is only relative for the 5 governmental, right? So accrual basis, we know we recognize revenues when earned, whenever we fulfill whatever our obligation is. So whenever we've delivered the service or the goods and we fulfilled all our when we've earned our revenue, we account for it in accrual accounting. Obviously, we want to match expenses against revenues within that current period. So that's the matching concept of accounting. So accrual accounting recognizes revenues when earned, and we want to match expenses with revenues, right? To kind of keep up with the matching concepts. Because that's the whole point of even like depreciation. That's a matching concept because we want to match the expense in which the period in which the revenue is going to be produced. That's the whole concept of depreciation. We know fixed assets aren't expense within the period they're bought because they're going to produce money or produce revenue for the firm. So that's why we allocate those expenses over a period of time systematically through the process of depreciation. So that's the matching concept. That's the idea of how we match expenses against revenues. Modified accrual. So we're going to recognize revenues when measurable and available, right? Measurable meaning, obviously, if the government levies a tax, they've assessed the tax on real property, right? So they've assessed that tax, so therefore it's measurable. They know what they expect, the monetary amount that they're going to expect, so it's measurable. Available, if you recall, after the calendar year, after December 31st, if it's within 60 days, it's considered what?
Available.
Right. If it's outside of the 60-day period, it's considered to be what? It's unavailable, so it's deferred, right? Deferred revenue, right? So if it's after the 60 days, it's deferred, it's unavailable. If it's within, it's going to be available. So there's the measurable and available. That's how we recognize revenues: measurable and available. If it's measurable, we know the monetary amount. If it's available, we know it falls within that 60-day period after year end, right? We recognize expenditures when the liability is incurred. So there's no attempt to match revenues, to match period of occurrence only. So we don't try to match expenses with revenues like we do on the accrual basis. The only exception to this is when we recognize interest and principal payments as expenditures when due. Obviously, we know when debt is outstanding that there is going to be installment periods or installments that are due that are made up of both principal and interest. So obviously, that's the exception of matching the expense when with the outflow is obviously when the expenditures are due on recognizing interest and principal on debt, which makes sense because obviously we have to match that. So are we pretty good there with the modified accrual versus accrual, the differences? So what's the difference between recognizing revenue between the two? On accrual basis, when do we recognize it?
We recognize it but when it happens.
When it's earned, right? When it's earned. What about modified accrual? When do we recognize it then?
When it's measurable and available.
Absolutely, right. And we know on accrual we match expenses in the period with that of the revenue producing. With the modified accrual, we were not concerned with that, right? Only when it comes to paying off debt. So a modified accrual revenue cycle. Let's just take a little example here and just look at how the journal entries would be based upon this data. So if you can see, the top two lines here are red, so that's pretty much the first part of it. Although all four of those bullets are relevant for this entry here, we're going to go ahead and just read through them all and just work through these entries. And then there's another page on the back end, or another slide that has the back end entries as well. So entries during year one, based upon this assumption at the top. So let's assume that property tax for year one is levied for $1 million, right? So we've levied $1 million worth of property taxes. Of that $1 million, $800,000 is going to be collected in year one. $120,000 is expected to be collected in January and February of year two. $80,000 is expected to be collected in March and April year two, okay? So when we record the levy, we can see here entries during year one. We record the levy of property taxes. So right now, we're going to debit taxes receivable, right, of $1 million, and credit revenue tentative of $1 million. And that tentative is there because remember, if you recall from the last class, we just set up an allowance, right? So that's why it's saying tentative. We'll get into that later on, but I just don't want to confuse anyone now. So right, for now, we're not going to put the allowance in. We're just going to say that's the tentative revenue, just to keep the example pretty simple. So once again, we record a property tax. So when we did the property tax levy for year one, the entry is going to be debit to taxes receivable of $1 million because we know assets are what, when we do our accounting entries, they're original debits, right? So that asset's expected to go up, so we're debiting it, right? So debit property or taxes receivable, and then we credit revenue for the same amount because we know revenue is an original credit, right? So that's our debit credit there. Debit taxes receivable, credit revenue. So then it says, if you remember, we collected $800,000 in the first year, right? So when we actually made those collections, obviously, assets are original debits, right? Cash is an asset. So we're bringing that in, right? We collected $800,000, so we're going to debit cash. Cash is increasing. We're going to credit taxes receivable of the same amount of $800,000. Why did we credit taxes receivable there?
We've already received it.
Right, we've received it, so we need to therefore reduce the asset of taxes receivable because we made the entry here and we debited $1 million. So now, since we've credited $800,000 here, assuming this is the only activity that we've accounted for since inception, we know there's still $200,000 in receivable, right? So that's why we credited tax receivable because it was an original asset, which is an original debit. So therefore, if we want to reduce that asset, we have to credit it, right? So if assets are credited, they're going to reduce it, right? And I'm going to go through and kind of explain journal entries of what the original debit and original credits are because I think that right there to me is how you understand double entry accounting. Okay, so that's, and if you feel that I don't really need to go through it as you get more comfortable, just tell me you don't need me to do that. But I think it'll help us understand journal entries. So that's why I'm doing that. So once again, we record the levy when we made $1 million. We debited tax receivable, credited revenue, right? We collected $800,000, so we debited cash because it's an asset. Original debit is an asset, so it's going up, and we credited tax receivable because we know we don't have $800,000 tax receivable anymore. So that reduced our receivable on the original entry when we recorded the levy. Okay, but now we have a year-end adjustment we need to make, right? because it says that 120,000 is expected to be collected in January and February year two. We don't have to correct anything there, right?
Right.
Because that's going to be available still, right? Because January and February falls within that 60-day period. However, 800,000 is expected to be collected in March and April of year two. We do need to make a correction on this entry. Why do we need to make a correction on a year-end adjustment for that 80,000?
Because we're not collecting it this year, we're
Right.
collecting it next year. It has to be deferred.
Right, and what did we do? And when we recorded that levy with the $1 million, what did we do? Just look at that entry. We debited tax receivable and we credited revenue for the full $1 million, right? So if we don't do a year-end adjustment, we're counting that $80,000 as revenue this current period in year one, because we already said we did, because we already accounted for it right here, right? So in order to, so pretty much this entry right here, this year-end adjustment, all we're doing is moving $80,000 of what we already accounted as revenue right here with the original credit, because we know a credit to revenue is original credit, right? So we've accounted for all $1 million, but we know 80,000 of it is not going to be current. It's going to be deferred. So therefore, we want to debit revenue, because revenue is originally a credit, right? So if we debit it, it's going to reduce it, right? So therefore, we want to make that year-end adjustment. $80,000 is not going to be revenue, it's deferred. So we're merely debiting revenue, which reduces it by 80,000, and then credit the deferred inflows of property taxes for 80,000. Because if we recall, remember, the deferred inflows is with the liabilities on the credit side. So that's why we're crediting it. So therefore, all we've done this last entry is moved $80,000 from revenue to deferred revenue. That's all we did. But in order to accomplish that, we have to debit revenue because it's an original credit. So the debit to revenue reduces revenue, and then the credit to the deferred inflows increases the deferred revenue. Does that make sense? Does that help how I'm explaining the original entries being debits and credits as far as increasing and decreasing the accounts? Does that make more sense with the journal entries?
Yeah.
Okay, now same example here. So now if you can see here, we're in year two, right? So we made that adjusting year-end entry to move 80,000 of revenue to deferred revenue, right? So beginning of the year now, what we want to do, we know that $80,000 is going to be collected in March and April, right? So what do we want to do? Last year, we reduced the revenue and put it as deferred revenue, right? Well, we know this year we're gonna collect that money. That's revenue. So the first thing we want to do when we open our books back up, we're going to say, okay, at the beginning of the year entry, we're going to debit deferred inflows property taxes of $80,000 and then credit revenue. And that just reverses it right back, right? It's really important. I know it kind of sounds tit for tat, but that keeps your years in alignment with the revenue. If we wouldn't have made that year-end adjustment entry, then revenue would have been overstated by $20,000 in the previous year, and it would have been understated by $20,000 in the current year. Does that make sense? Very simple entries, but it's important to keep all the information intact, relevant to the financial statement users. So it makes sense then, right? Why we've reversed it at the beginning of the year, because we were counting that as revenue. So now we're going to collect that $120,000 in January and February, right? And the $80,000 is collected in March and April. So we're just going to combine those on this entry. So that's obviously 120 and 80 is 200,000. So when we collect that, once again, assets are original debits. So we debit cash. It's money coming in. We debit it. The cash is going up. Cash account's increasing. Taxes receivable, 200,000. We're crediting it. We know assets are original debits. So if we credit an original asset, it's reducing it. So the 200,000, there's the rest of our taxes receivable marked reduced down. Does that make sense? So it makes sense how, if it's not available, how we defer it. We might count it as revenue in the beginning, how we did in this entry. When we levied it, debit taxes receivable, credit revenue. Then we collect some money, right? Taxes, reduce the taxes receivable. Year end, we say, okay, we look at the situation. 80 of that's not available. Let's go ahead and move that. Let's move that from revenue to deferred revenue. That's all we did. Next year, okay, let's open it up. We know we're collecting it. Let's go ahead and move it from deferred revenue back to revenue. and then let's collect their money. Let's bring the money in and then reduce that receivable. Make sense? So uncollectible amounts. Once again, we know, unfortunately, when we operate on accrual basis of accounting, if whether it's for profit or not for profit, in this case, we're dealing with the not for profit. It's non-exchange transaction of taxes. Obviously, some people might not be able to afford the taxes. Some people might just have moved and let it go, not paying. They don't care about the property taxes. So obviously, we're not going to be able to collect it all. Obviously, on trade receivables, based on credit with your partners or your clients or your customers, we know some of those people are going to default on that. So we have to set up an uncollectible account, right, an allowance to account for not being able to collect that. So an allowance for uncollectible taxes is recorded at the time of a tax levy. So since uncollectible amounts will not be available to finance current expenditures, revenues are effectively reduced by the amount of the estimate. So to record the levy, once again, this is just like the original amount. Taxes receivable for the entire amount of the levy of $1,075,000, but of the $1,075,000, 75,000 of that is going to be deemed to be uncollectible. So we're going to credit the allowance for uncollectibles of 75,000, and then credit revenue net of uncollectibles of $1 million. So there's our tentative revenue from the previous example, right? Because we know 75,000 is going to be what we assume to be deemed uncollectible, right? So this allows us to carry the net realizable value of property taxes that we expect to bring in. Same thing on our for business sector of accounting. When we make a sale, and we've earned the sale, right? We know that we are going to debit accounts receivable, right, and then credit revenue, right? But ultimately, we're gonna credit an allowance because we know that, let's say whatever, and it's based upon a company. It'll say, okay, well, we're gonna do like 1% of the overall AR is going to be considered to be an allowance for doubtful accounts. Okay, and it's usually, a lot of times it's done at a month-end closing entry is the way we did it at the company I worked at before. We'd say, okay, we're using X amount of percent of the overall AR balance at the end of the reporting period, at the closing entries for the month. We would go ahead and say, we would base it based upon whatever that balance was in the AR. We would apply that percentage to it, and then we would make that adjusting entry to set up that allowance, right, to keep our AR within net realizable value. Same thing here. When we record a tax levy, we know some of it's not coming in, so we debit the whole entire levy, credit the amount deemed uncollectible, credit the rest as revenues. And once again, what does that keep us? What does that accomplish? What does that keep us from doing?
Like from overspending.
From overspending, because that'll keep us from overstating how much revenue we really have coming in. Because we know if we don't have an allowance for uncollectibles, it's going to be overstated because we know there's no way we're going to bring it on. Right. So just important here, just set up that allowance for uncollectibles. Just think of it exactly with trade receivables, with the allowance for doubtful accounts with your for-profit business accounting. Okay, makes sense there? So what if we want to write off an uncollectible amount? Do you recall how to write off accounts from your your intermediate course? Did you all get into writing off bad debt?
Yeah.
A little bit. Okay, so to write off an uncollectible account, it's going to have no effect on revenues or expenditures, right? Because you can tell obviously from the account here, or from the journal entries, there's not an expenditure or revenue even listed on the accounts, right, that are debited and credited here. So obviously, when we set up the allowance for uncollectible taxes, it's an original credit, right? Because we're debiting the taxes receivable and crediting the revenue, but in between, the difference of what we find uncollectible is going to be that credit to the allowance. So we know the allowance that we set up is an original credit, right? It's a credit. So if we want to write off a tax that we seem to be uncollectible, then all we're going to do is, if the tax here, for example, is $5,200 of taxes that we expect to be uncollectible. So we're going to get it off the books, right? So we're going to now debit the allowance for doubtful taxes, right, by $5,200, and credit taxes receivable. So all we've done is reduce the allowance by $5,200, not 52,000. I think I said that the first time. And we've reduced taxes receivable by 5,200. Does that make sense? So therefore, what this has accomplished, like I said, the allowance is now reduced. It's reduced by 5,200. And remember that original taxes receivable is original debit. Well, we just credited it, so we've reduced that asset as well. So we've in essence written off part of that asset, right? Does that make sense?
Yes.
So it's just a direct debit to the allowance because it's an original credit, so we're reducing it, and a credit to taxes receivable because it was an original debit. And now those taxes are off the books now. Make sense? No effect on revenues or expenditures. Okay, we'll just go through this example, and I think this will be a good stopping point for the day. And we'll pick back up here next class. The modified accrual expenditure cycle. I know we've already went through this in the last chapter, but I just want to do it one more time. Supplies are ordered at an estimated cost of $3,500. So when we place the order, what do we have to do? We encumber it. So it's a debit to encumbrances, right, of $3,500, and then the credit to the budgetary fund balance reserved for encumbrances, right, $3,500. Then the supplies are going to be received with an actual cost of $3,000 plus shipping of $250. They got a little out of order here. Some people do these orders when they receive the goods. They'll do the expenditure. They'll set the liability up first and then reverse the encumbrance. I like reversing the encumbrance first because it's easy to forget to do so. If you just set up the expenditure, you think you're done. I mean, by nature. So I like reversing the encumbrance first because that way you just don't forget that step. But you can do it either way. It's up to you. I prefer doing the reversal first. So we encumbered $3,500 first, set up the reserve of the first entry when we placed the order. We received the goods. So let's first, if we'll jump down to the third entry there, let's go ahead and reverse that budgetary fund balance reserved for encumbrances. So we're going to debit that $3,500 here, and then credit the encumbrances, right? So now we've unencumbered the funds that we encumbered, right? So now we're back to square one. But now we have a liability, right? But it's different. Remember, the actual order itself, the invoice could be different from what the actual order was, right? So in this case, it is different. But we unencumbered the $3,500 because that's what we encumbered. So we received the whole order, we unencumbered the whole order, but it was a little less. It's $3,250. So now we set expenditures up for $3,250, and then accounts payable of $3,250, right? Because that's how much the invoice was for. Because now we have those goods, so we have a liability, right? And then obviously when we make the payment, we debit accounts payable, and then credit cash. Why do we debit accounts payable on the payment?
Well, accounts payable is an original credit.
Right, because it's what? Accounts payable is considered to be what?
Liability.
It's a liability, and we know liabilities, like you said, is an original credit. So when we originally credit accounts payable, it's increasing that liability, right? So when we pay off a liability, we have to reduce the liability. That's why we debited it, right? Because it's reducing a liability. Why are we crediting cash right there?
It's an asset.
Right, it's an original asset, right? And original assets are what?
Original debits.
They're debits. So if we're debiting an asset, it's going up. So therefore, if we know we're paying the vendor off, our cash is decreasing, right? So therefore, we have to credit that account to reduce our cash balance. Make sense? Make a little more sense of how journal entries flow with the way I'm explaining it, with debits, original credits, original debits, and stuff of that sort. I really think that helps keep everything intact there. So there's the modified accrual expenditure cycle. Like I said, I think this is a good place to take a break, and we'll pick back up. We'll start off with this slide again on Wednesday and just go through it one more time because I know repetition's the father of learning. You can never do it too many times. And like I said, this will be some stuff. There will be on the midterm. There will be some journal entries on some problems, but there should be no problem with it. With how we're going to constantly work through it. And we're going to be working through journal entries a lot in this class, so we truly understand it. So, like I said, that's all I have for today. Continue studying chapter 4 and continue working in chapter 3 as well if you're still in chapter 3, and get those connect assignments in. make sure they get in on time as well. Any other questions or concerns about anything right now in the course? Everyone's good? Okay, well, that's all I have for everyone. I thank you for your time, and I will see everyone again on Wednesday, and we will be continuing with Chapter 4.